Good afternoon, everyone, and thank you very much for your time this afternoon. Today we'll be discussing the alternatives to the UK market, as a lot of people tend to invest in the countries that they've either been to, visited, sent their children to school in, and that sort of defines the parameters for them investing. So we want to be discussing today the macro and micro looks at markets outside the UK and why they're very, very promising. So I'd like to introduce Jerry Marshall. He's a director for wealth management at IP Global. Thank you for being on board, Jeremy. Just first of all, we just want to explain why IP Global and why we are what we're doing. We're very much a research and data-driven company, property company that will invest in the projects that we bring to market. So we underwrite with every development that we take on, and the main part of it is that we provide a full end-to-end service, and we provide a truly global service. So we're in offices around the world, but this is the big differential. We can help with getting financing, introducing to lawyers, getting tax advice, creating the right structures to have a very successful property portfolio. Go to the next slide, please.
Thanks, Andrew. Yeah, no, just to add to that, I think research, I think, is all important in these environments. But I think, yeah, the end-to-end service is something which is slightly our relationship with clients is very much for the lifetime of the property and investment. So, you know, our aspiration is to have 20-year clients, basically. You know, we'll be hand-holding throughout the entire process and giving advice and research up until the date you want to sell. And then being able to help sell that property in the end to kind of realize those investment returns. So we are very much tied to our clients for that duration.
Excellent. So we've invested in 18 different countries globally, and inwards of helping our clients buy over 5,500 apartments in tallying about $3.2 billion. So we understand markets and we understand how to review them comparatively, and then we can make informed decisions where to invest and create profitable real estate investments. So we've got offices around the world. Our head office is in Hong Kong, and we were set up in 2005. And we've got offices around the world. As you see, in the yellow dots are our actual offices. So we've got a large reach.
But generally today, what we're going to be talking about in the session, number of different things. Firstly, will just be a recap really of kind of actually what we're doing, what we're interested in, what markets we're buying into and why, but just about how. You know, we are a research and investment company fundamentally, and so it's just a refresher to think about really whether you're a first-time investor, whether you're institutional level, the things we'll be looking at in terms of how to pick an investment is everything we're based on afterwards, all the research. So the data coming that we've got to compare across Europe is very much the bloodline of how we kind of choose what areas are most successful and likely to succeed in the next 10, 15 years. We'll have a little bit of a more deeper dive into Germany and Portugal, in specifics of why those markets are of interest to us and the data behind those. And then effectively what a proper real estate investment will look like. So process, tax, mortgages, you know, how much that's going to cost, and most importantly then, you know, the investment returns when you come to sell maybe in 10, 15, 20 years time. So moving on then to research, and this is really just to give a kind of grounding again, and a bit of reference point into the data we're going to show afterwards. But effectively, when we're looking about research into property, we're talking about the movement of people. That's, you know, to understand where's a good place to buy is to look at the long-term averages and the movement of where the money is and where people are. So the top left here, housing supply and demand is key, the focus, the backbone of everything that we want to look at for a successful and healthy property market. And so we want to see not enough property for a rising population effectively, and all the others are important, but that's the most key thing for anything to be right. So everywhere we look at it, has an acute problem. Population demographics, of course, we want the people living in those areas to have enough money for the buying and the renting there. So we want to see a broad range of economies modern service-led industries leading those cities, and trying to avoid maybe cities which are maybe mono industry. You get some cities in America based purely on car manufacturing and so forth. And so, modern industries, modern service-led economies is what's kind of safer and broader. Economic outlook and regeneration infrastructure, we really want to see public and private money being spent on an area. We want to buy knowing that this area is going to fundamentally be a different place in 10 to 15 years. And so, if not completely different, certainly always on the upward curve of desirability for the renters in the area, rather than either stagnant or going down. So we want to see that upward mobility. And then research on the micro level. I mean, really what we're talking about is the specific streets or the development we're actually going to be looking at there. So developer track record is all important. We want to go those common pitfalls of, buying into or working with people that maybe don't have the experience or finances behind them. Knowing your legal obligations, doing all the proper research properly, knowing every cost throughout the process, and your legal rights, and making sure you're buying into countries and jurisdictions which have protections in place throughout the process. Now, we'll give a frame of reference before we talk about all of Europe. We're currently buying into Portugal and Germany outside of the UK. Obviously, UK is probably still has been our biggest market over the last 10 years. But these two certainly offer a healthy alternative. And as a brief kind of, elevator pitch of each country, I suppose, Portugal is a smaller country and smaller economy than Germany and UK, of course. But it's actually probably one of the most, it's changed its market fundamentally since the financial crisis. It did have big debt. It did get a bailout, but instead of all the other countries which have bailouts and imposed austerity measures, it had an aggressive fiscal policy and spent its way out. And it's worked extraordinarily well for the country. And so it's changed itself. It doesn't want to be just manufacturing and tourism focused. It wants to be digital, tech, sciences. And so it's particularly making Lisbon and Porto the epicenter of that. So for us as an investment company, following the money, following the movement of people, Lisbon and Porto is really the only places we're really interested in buying then, certainly not down the Algarve based on luxury and tourism. So these two cities account for anywhere between 70 and 75% of the entire GDP of the country. So as much as it is a smaller country GDP economy overall, these two cities count for an enormous percentage of it. So are cities which really punch above their weight. So are interesting in terms of rentability and capital growth. Secondly, then Germany. It might not be the first thought of everyone. UK often can be it is, the world's, prime market for foreign investment. But Germany, the fundamentals and stats of Germany speak for themselves, really. It's the fourth largest economy globally. It is very stable. Now, UK has left the EU. It counts for 25% of the entire GDP of the EU, so it has a lot of political and economic power. And its projections for growth is, 2 trillion euros, which is a 59% increase in GDP over the next 15 years. And we'll look at some of the reasons why that's going to happen in the next while. But that really is, if you want to put money somewhere safe, then that's a very good sign. So Berlin, particularly for us, is the market of interest. Generally, it's Eastern Germany, but particularly Berlin, which is the capital. And really, for many reasons we can look at, is expected to become a major player in the world over the next 20 years to equal, likes of New York, London, and Paris, which seems, on the face of it, like a tall order, but it is the biggest population in Europe outside of London. It's certainly undervalued, and that's because of its historic past. The wall effectively stagnated and stopped any kind of organic growth happening in Berlin. So all major industry flourished in the other cities in Germany, but Berlin, being the political heart and twice the size of any others, over the last 30 years since the wall's come down, that vacuum that's created is suddenly being filled up with big industry and big business who want to take advantage of being in the capital, having cheaper rents, cheaper overall costs for their staff largely, and so the overall speed of recovery there is why we're particularly interested in Berlin. So Andrew, here now we've got a few stats on some particular great stats with some research data, and Andrew can come some of these.
Yeah, thank you, Jeremy. Let's now dive into understanding the European market, compare the 7 major economies in Europe. This first slide is talking about the economic growth of Europe. So the red line in the middle shows where the GDP for those economies were before COVID, so 2019. And you can see the blue is where 2020 was, orange is where 2021 is, gray is next year. So what's really interesting on this is just showing by the end of this year, Germany is going to be already past pre-COVID GDP levels, as is United Kingdom's very, very close. It'll be in the first quarter of next year, followed by Portugal, which is also in the first quarter. So you can see clearly here that Italy has got quite a longer way to go. It's going to be mid part of next year before it reaches pre-COVID era. But yeah, this is a very interesting slide just to compare each country in terms of their growth going forward.
I think certainly in terms of the year's future as well, particularly like Portugal and Germany, they seem to be getting, in terms of the 2022 growth and the pickup there, the future years after that, is what's really exciting.
Absolutely. So this is a very interesting slide, which is something that it's a great indicator for why you invest in these countries. So Germany clearly has got the largest GDP in Europe, followed by the United Kingdom. As you can see, they've in the next 15 years. So the grey box, the grey graph is showing you what's happening from now to 2035, the projections. The orange is showing where it was from 2000 to 2020. So it's interesting to see how much Germany has got a huge, still going to be, they're putting in $2 trillion euros into their economy. United Kingdom projecting also a very large GDP growth over the next 15 years. I think this is because of the uncertainty of Brexit now, but you can also see how Portugal it's having sustained growth as well. We can see that Italy's, it's a major economy, but it's also hasn't had the same level of growth as the other economies.
Yeah, and I think a lot of what we're kind of looking at here is the comparative size, of overall. The first country in Europe to top 5 trillion euros. It's a big thing, and you might well ask, is it, yes, why then not France? Why then not some of the other ones? And probably on this slide, particularly Ireland. In terms of its absolute astonishing rise in growth over the last 15 years, and then actually looking very healthy over the next. The question for us in terms of property is sustainability of that. We are really talking about Dublin, not necessarily the whole country, and that is very much focused on the tech sector. We've got 4 or 5 massive companies which have really seen that propagation of success, and it's hard to see necessarily property prices rising the same way they have done where they are in Dublin at the moment, which is arguably toppy. We do like it as a market. But also the other thing we've had is the access to foreign lending. That can be something we'll stop in our tracks immediately. And Ireland is incredibly difficult if you live outside the country to get any reliable lending. Maybe 1 or 2 banks do it at the moment, maybe around about 5% interest. But if we've only got that number of banks, we're probably not so keen. And equally, France, is actually looking quite interesting in terms of the size of economy and its growth. But their taxation rates are extraordinary, on your investment into property, on acquisition, on holding, and then return. You can very easily be hitting into the 40–50% tax margins there. So comparatively, UK, Germany are more interesting.
So this next slide we're showing government debt to the GDP ratio. So clearly we're seeing the economies that are well managing their GDP level, like Germany, which is the red line, and they after 2001, you can see that they're declining and working on their deficit, which is a good healthy sign. It shows how well managed that government is, and they're also the same for well, Portugal actually has one of the strongest curves that are coming down. Surprisingly, the United Kingdom is actually increasing their debt levels slightly. So it's an interesting level. This is something that it's well worth looking at in terms of what the government's borrowing, and just to see how well organized they are at keeping their costs down.
I think that reflects safety in the long term. Basically, if you know, Germany particularly, if it doesn't have a very high debt compared to its GDP, it means it can spend more and so forth. And yeah, you know, the UK, it has had an extraordinary circumstance, Brexit, and I think it's probably mitigating its risk and keeping itself on the world stage by spending a bit more. But you know, in theory, that would come with a slightly higher risk, having a bit more debt carrying over there.
So this is a very interesting slide to show. This is what a lot of, so this is European FDI flows. So, you know, foreign direct investment. This is what a lot of, you know, the international companies would be looking at. So institutional money. So this graph shows quite clearly where, you know, where the big money is being spent and coming into those countries. Surprisingly, interestingly, the United Kingdom was the highest before Brexit, and since then, so this graph is between 2017 and 2020. You can see that Germany is getting the lion's share in terms of foreign direct investment, followed by the United Kingdom. Yeah, it's a very good graph to show just how much money is going into these economies.
And the thing I'd say for Portugal, as much as it obviously is a smaller amount there, that, you know, again, we are talking about the vast majority of that income coming into the two major cities of Lisbon and Porto. So, you know, outperforming comparatively. Yeah.
So European unemployment trend. This is between 2010 and 2030. If we look at the lower ones, you've got Germany having quite a very consistent and very straight line. It just shows you sort of the mentality of the Germans. They keep things very sustainable, very long-term planning. The UK, which there's a spike for most of them, which is obviously led by COVID happening. And as you can see, they're all after 2021. There's a huge decrease in the unemployment rate. You can see quite clearly here, though, how I get a lot of clients asking why we're not in Spain, and you know, this is actually graph does explain quite a bit why we're not there. Is that there is a high level of unemployment, and this is something to be really bear in mind when it comes to investing in the long term in that country.
So now we're narrowing down for the country we're most interested in, and hopefully give some kind of reasoning actually to some of the other markets we're not currently investing as to why. A lot of that might come down to finance, and you know, or you know, like we just said about kind of specifically high unemployment in certain markets, which make it a bit kind of higher risk for us. But going for these two markets now, Germany first. The populations per city, and again, we're looking at what's happened since the 2000 up till now, and then from 2000 over the next 15 years onwards. So the standout here, and yes, look, we've got some great stats from some of the other cities as well, but for Berlin, which is twice the size, you know, for a city of about 3.7 million, to have the kind of growth rate it already has, and to be continuing to grow at almost the fastest rate of any, that's not insubstantial. And the fact that they've been able to reduce unemployment in this same time, you know, back in 15 years ago, we maybe had around about 15 to 17% unemployment rates, but now back down to around about 5%. You know, we had 250,000 people joining in that period of time, but still reduce the unemployment in that time. That's a big success story for an economy. And so the fact that we're likely to see population still rising another 20% in 10 years, 15 years, that's quite exciting. So also, you know, we see on the far right side, Leipzig, that's actually got some particularly big population increase, and it is a city we're interested in because it's almost the same kind of investment story as Berlin. So one to look out for, as we say there. Now, all very well then. So like we said before in this research, supply and demand is the most important thing. And this is for us, property investors, kind of time to lick our lips really, because this is about, the existing housing market it is now, and then with this population increase, what the need will be for housing up to 2035, the next 15 years. So what we've done here is extrapolate data, and we've taken probably the best case scenario of what they can build in market. And I was discussing earlier, it's probably one of the most tightly restrictive markets of what they can build there. The local municipality and legislation, it's not easy for developers to get planning. So over the last 15 years, the highest annual amount of apartments they managed to, or houses they managed to deliver was close to 20,000. So what we've marked here is 20,000 units per year. Extraordinarily unlikely that they will reach this target, but even if we put this as a best case scenario, even at the end of 2035, we're still in massive deficit of housing there. And for property investment, that's everything. That's pressure on rents, that's pressure on prices. And so with this growing population and this increased wealth, this is exactly what we want to be seeing. And then comparing them the top 8 German cities in terms of GDP growth over the next while, following the population curve. You might well expect Munich to be up there and to be heading this. It is the traditional kind of, in Frankfurt maybe for finance, or Hamburg, but Berlin, probably because it's the epicenter of the startups, it's the more modern city in terms of industry. Its next 15 years looking to have 80% GDP growth is phenomenal. And again, similarly, we can see on the right hand side of Leipzig probably being the second of the major German players there. So exciting. This is relevant in terms of the population demographic then. So what we see here is your average household income. So we're looking at 2000, 2020 and 2035 again. And what we see is what was historically a relatively poorer city, the average wages, the vast majority of people having 35,000 euros or below in the year 2000. Come the year 2035, that's substantially reduced. We've already seen an 18% drop of that bracket, but that's going to be another 37%. But really importantly, the bracket of households which have a family income of 100,000 euros or more is jumping 254% in that period of time. And so for affordability, for prosperity, for liquidity in market, there's more and more people who can afford this higher bracket of housing prices and rents, and absolutely what's going to feed the growth continuing. So what's happening in terms of spend, we've looked at that slide before of Germany generally having by far the biggest amount of billions coming into market over the last 4 or 5 years. But Berlin specifically, and as I mentioned, it's got about 70% of all the startups in Germany are centered in Berlin. But these are just some of the blue ribbon ones, major billions of investments here. Firstly, which is not on this slide, Brandenburg Airport. Up until October 2019, Berlin didn't have a proper international airport which would fly to the Middle East and fly to Asia. So crazy as that sounds, the capital of Germany, the biggest economy in Europe, you couldn't fly there directly from where I am here in Abu Dhabi, for instance. So now, rather than having to go to Frankfurt or Munich and migrate over, we can. And we've seen this time and time again. That's going to make huge, huge changes in terms of the attractiveness, particularly from China, but for the Middle East and Russia and so forth, in terms of the investment coming in. And so the top left, what we see here is Tegel Airport. That's actually being changed and turned into a big technology park over the next coming years. So that's going to be another 20,000 jobs, another 1,000 companies based there. Siemens on the top right there, that's a major international, it's a German company, but a big international player. They're going to put their research and innovation campus in Berlin. That's going to be another almost 12,000 jobs. Tesla obviously is a huge brand name in the world right now, and they're going to have their European headquarters, their Gigafactory in the southeast corner of Berlin. And recently announced as well, they're going to have their battery plant, which is going to be the largest in the world. So that was fought over fiercely by cities around the world, and particularly US cities. And so Elon Musk has decided to be putting the battery plant here in Berlin, which is a huge coup, not just for Europe, but yeah, particularly obviously for Germany and for Berlin. And bottom right, Europa City, something which has been being redeveloped for a few years now and will continue probably for the next 10 years to get redeveloped. A major, 600,000 square meters of residential and majorly office space just at the north of the central train station here. So we've got a mixture of finance companies, banks, insurance firms, and so forth, and just well-paying jobs right in the heart of the city. So, nothing could show more. The type of company, the scale of investment, and the speed of it all happening is kind of unquestionable for the capital here of Germany. And for reference, I mean, here's our track record in Germany. We started buying about six and a half years ago there, and so these are the 10 projects which we've completed and bought and sold. We have done 19 projects thus far, but we've got 9 of them which haven't completed yet, so we can't show the kind of exact details of price in market yet. But these are all the ones which have completed. We can't show the same stats exactly for Portugal because all the projects we've done there are yet to be completed. About 5 of those, but here we can see an average capital growth per annum around about 10% in Berlin. So, and that's the dark blue lines here, and the orange marks here is those people who have leveraged. So, taking 70% mortgage, essentially their return on investment, considering they've taken that leverage there. So, it's very difficult in the last 5 years in the global market to see these kind of returns, but because specifically the kind of timing of Berlin and its undervalued nature compared to other capital cities, this is why we've seen these kind of returns. And for all the stats we just talked about, it's why we can predict, if not the same, very close to this over the next 10 years again. Portugal then, as a macro, growth-wise, IMF has predicted one of the healthiest recovery patterns around Europe for Portugal. So GDP should rebound by 3.7% this year in 2021, and then in 2022 to be growing by 6%, which is one of the largest around in Europe. And so this is mirroring everything that's been happening since the financial crisis, when they did have issues and they've turned their economy around. We can see the unemployment dropping off dramatically since then. Of course, a little bit of a rise in the last year, but actually not compared to other markets in Europe. We see the long-term forecast here of sustained healthy growth in this market, and that's a national average. And considering that we have lots of areas which wouldn't necessarily be investment worthy, a big proportion of this growth is going to be based in the 2 major cities, Porto and Lisbon here. Sales and rentals, again, we can see what's been happening over the last few years, in different market segments on this graph on the left. From the top 5% to the middle, and the kind of market where we're interested in investing in these market cities is the kind of property. It's not super prime, but we want to go into the kind of property which locals and investors can get into. So ours have been averaged around the kind of 6,000 euros a square meter in Lisbon, or maybe 3,500 to 4,000 in Porto. And so this is very much in the middle section of here, and we can see just how far it's done. In terms of growth for the last recent past, and projections ongoing then are for a similar trajectory. And then for the rental market, particularly in Porto, one of the few markets across all of Europe which actually saw rises in rents happening, in 2020 in the middle of COVID, just supported by its lack of supply and the amount of people there and the kind of wages which are happening there. Lisbon did take a little bit of a dip, but mostly everywhere else in Europe did as well. So happy with that. An infrastructure investment, what we want to see in every market. Lisbon particularly, its connectivity to different markets around Europe and the world, and Porto just opened international flights to the Middle East and to Asia into back end of 2018. That has encouraged over the last 3 years companies like this, Google, Amazon, and Mercedes, Zalando, one of the biggest online retailers in Europe, to set up some of their European headquarters in Lisbon, and coupled with that, seeing major infrastructure and regeneration spend. So bottom right here, we see 1.1 billion euros is being put forward to this proposed for the airport, which will probably happen over the next 6 years. And then we've had another 200 million in just tram link extensions for Lisbon in particular. And then the ports had work into in Porto as well. So really exciting amounts of money coming into these 2 cities.
Also a good one, we had a good question just now, Jeremy, about on the graphs looking at the European countries about The Netherlands looked like it was doing well in GDP, you know, why we're not investing there as ourselves. I think I know the answer to that, which is we've looked at that market and we found it very, very difficult to do international mortgages. This is a big thing that we look at in terms of, you know, how safe the country is, low political risk, where the population's growing, and all the macro and micro. But a very important part of real estate is leveraging, and you can get really big returns. So if you can't get access to financing for our overseas clients, then it does make it very difficult for us to invest.
Massively, I totally agree with that. And I think there's always a balance. There's always you know, a lot of things have to be right for us to buy in. And you know, Amsterdam has been attractive for years, similar to what we talked about in Dublin before. You know, but you know, for as much as the economy does look healthy for the next few years, yes, I mean, of course, you know, the lending stops us completely. But even if we could have lending, there's a certain argument there of where their prices are in long-term averages and value. You know, we certainly can find value in places like Lisbon and Berlin. And it increasingly gets difficult in places like Dublin and Amsterdam, because they have been very successful in a short space of time very recently. So we have to be careful when we're looking at that. So
I think another interesting point is that it took us, we looked at the Portuguese market for about 4 years before we entered it. We saw it was a strong market, but we very much take our time when it comes to, because there are so many parameters that we have to look at. Yeah.
And actually, we spent 2 years working with the local banks to basically create products for international buyers, basically in the way that we'd like. You know, it takes an awful lot to make things safe into an investment model there. So, yeah.
Absolutely.
So, Andrew, I think you're gonna go through. We've used some of our live examples here, but this is to talk about the nuts and bolts.
Exactly. So we'll talk about our projects that we have in Lisbon and Porto first. So this is just an example of what stock that we have. So this is a project in Bela Vista is in Lisbon. We can get mortgages for our international investors at between 0.68 and 0.84%. And you can borrow up to 65 to 70% loan to value on that property. So this property has a 5.5% rental yield. The minimum equity you would need, including your acquisition costs, would be circa 141,000 euros. And over a 10-year period, we're looking at return on equity gross at 180%. So it's about 259,000 on top of your 141. So you know, on an IRR basis, it's 12% per annum, which is, you know, very strong. And this is the power of leveraging with these interest rates. We can get them. Then we look at Porto. So Porto it's more affordable per square meter, so you can get slightly more for your buck in Porto. We can get, again, the same mortgage rates, 0.68, 0.84. Purchase price for a 1-bedroom is 250,000 euros, 5% rental yield per annum. And your equity, the minimum equity, if you were to get a 70% loan, plus your acquisition costs and all costs, would be 102,000 euros. And the return on equity over 10 years, we're projecting 165%. So, you know, 169,000 pounds gross profit.
I think in terms of you know, what we kind of look at here, things to point out is, you know, you've been in, I think we've been in the property game for like 18 years, haven't you, Andrew? I'm slightly less than that, but, you know, still for a long, long time, like we have not seen interest rates like this at all. You know, in fact, you know, it's actually, even the UK, we're going to compare, you know, as the major market, now is about as cheap as it's ever been. You know, we can get some mortgage products can go as low as about just over 3%, you know, and they might be, you know, fixed for a couple of year period, then going back to LIBOR, you know, maybe like 4.5 or something like this. So, yeah, you know, UK cannot compete to get interest rates under 1% and to follow base rate. You know, even if base rates slowly increase over the next 5 years, this is next to giving money away. You know, this is so, you know, you can really just you don't need a property to grow in value hugely to make money here. You can have a tenant paying off your property for you, you know, being in positive cash flow status because your interest is so low. And yeah, I mean, that's something which, you know, you could have a 5-year hold and make decent money on that. You know, that's it's incredibly attractive to get these.
I think also another point that was raised in the polls is strong sentiment is that the strong rental markets. And I think this is something that's really interesting about Lisbon and Porto, particularly our Bella Vista project, which it's in the historic area of Lisbon, where you've got a lot of, there's very little land. Lisbon is one of the oldest cities in the world, and this product is very high end, has, you know, air conditioning, it's got parking, it's got incredible common areas, but very, very high quality, brand new. Compared to what's available in the market for rent, Bella Vista will be at the very, very top of that pile in terms of quality, in terms of desirability, and it just makes it an incredible rental product for that market, incredibly attractive. So it's something just to point out in terms of also Little Living, which is one of the most stunning developments I've seen come across. It's in an area that's right next to the beach and in a stunning location. It was a former site that used to be a sardine tinning factory, and they kept some of the essences, so you might see a little chimney stack there. That was originally in the original design. So it's got the old and the new mixed in, and it's very cleverly done. But it's a very strong rental market. You've got excellent transport links to get around.
Yeah. In terms of, I mean, just so people are aware as well, specifically for these, the one on the top in Lisbon is completed now, so it has no development risk, and the one in Porto is completing halfway through 2022. So that would be a construction milestones payment plan. But objectively then, just on a macro sense, this is what the investments look like. Tax in Portugal on properties, acquisition cost around 9%. I think that, you know, some people might think, oh, that sounds quite high, but to be honest, that's about market average now for anything across Europe. Now, if you're thinking UK is cheaper than that, it's not. You know, if you've got have any property in the world, if you're not a first-time buyer, your acquisition cost is basically 9% in the UK now. So this is, you know, accounting for lawyers, notary fee, you know, your mortgage cost of setting up, and then the government transfer tax. So that's what to expect if any market really nowadays. So just, you know, bear in mind that on top of your deposit is your equity needed, and all our cash flows would show that kind of thing. Income tax, it's fixed for non-residents at a rate of 28%, but there's multiple deductions available. You know, kind of like the service charge on the properties and the management fees and so forth. So that can be nested off slightly. So, you know, it's about an average kind of income tax level for around Europe. And capital gains, again, similarly, it's 28% of the net sales profit. So bearing in mind, a lot of people forget this with most property markets actually, but when you come to sell the property, everything you've spent there, that original 9% of acquisition costs, almost all of that can be deducted off on your capital gains in the end. So, you know, the government will consider these as, you know, costs for your business effectively. So when you come to sell, then you'll net that off. And so before anything's deducted and taxed. So, yeah, so this is looking at some real projects that we've got in Berlin and showing the return. So we've got our new launch that we have called Boat House, which is in sort of southwest of Berlin. It's surrounded by, you're 15 minutes away from Elon Musk's new factory, new gigafactory. As well as Rolls-Royce HQ and 2 huge science parks that have multiple businesses in them. We can get mortgage rates at 1.5%, which are fixed for 10 years, and we up to 70% loan to value on that property. The property prices here are between 400,000 to 750. We have 1 and 2 and 3 beds. The rental yield is 4%. So your minimum equity, including your acquisition costs and tax, everything, it would be 170,000 euros. And your return on equity is 180%.
which is 306,000 euros. So that's 12% per annum return. And the Ambassador, which is in the very, very center of Berlin, in Mitte, we're actually right next to some of the biggest embassies there, like the Chinese, the Australian, and several others within less than a 500 meters radius, which is why it's called the Ambassador. But the target market is young professionals that want, these are studio apartments. They all have balconies, but right in the thick of it in the city, easy to get around. So we can get mortgage rates at 1.5%, up to 70%, 65 to 70% of the value. The prices are between 250 and 340 for a studio, and the rental yield is 4%. So the minimum equity you need is about 100,000 euros, and the return on equity is about 175. So your profit is 175%, 175,000 euros on that one over 10 years. So it's a 12% IRR.
So look, I think exactly both. The thing we can see here is like really, really healthy 10-year potential returns, and this is kind of bearing in mind the, all the major industry kind of forecast, basically the capital growth and the rental income there. But yeah, two different stories basically, as Andrew said. The one in the city centre, which is for kind of short-term tenancies, people living in the centre and thick things, and then the more lifestyle one, kind of half an hour from the city centre, but equally got a huge demographic of engineers and scientists and all those kind of people who are living and working in those big industries around that area, which will push in this market forward. So how then do we get these big return on equity figures there, the percentages, and for all this growth, for all these great stories about Germany and where all that growth is going to come from, it's almost a bit unfair really, but we've got the tax environment is extraordinarily attractive in Germany as well. So we've similarly got about 9% acquisition costs in Germany. So 6% for the government stamp duty and lawyers, notary and so forth. Interestingly, it would actually be an extra 5% if you go with mostly any agency in Germany. They have a standard anywhere between 4 and 6% plus VAT for their agency fees. Purely from the way we acquire buildings, we don't charge that. So in theory, people save a flat 5% with buying from Germany from us. So that's what your upfront costs are. Income tax is a graded scale from 14% up to about 57,000 euros per year, or 45% for 270,000 euros and above. But there is multiple deductions for here. So tax efficiency for income tax is really good. So we've put this example in here for one of the studios for Ambassador, just for argument's sake here, but the 250,000. So we see the rental income around 4%, almost 12,000 euros a year. We can deduct all the interest on the loan, which is about almost 5,000 euros. We can deduct the running costs, so that's your tenant management fee and your service charges there. Germany has a depreciation expense as well, so about 2% of the property value per year can be deducted off your income. And so what we're left with here is a fraction of what was left. So the taxable profit it is only 589. So that 14% bracket, you're paying basically no income tax at all. And so if 57,000 is the level before it jumps up, you could probably have 3 or 4 different properties in Germany and just about hit that marker if we go into the higher tax bracket. So it is very tax efficient. And then I know some of you will know it, probably the headline stat about buying into Germany, the capital gains tax. Property is a long-term asset, so this should be no issue for anyone, but 10 years. So it's a very German, very sensible ruling. If you buy and hold a property for 10 years, you pay 0% capital gains tax. So considering it's probably likely to be the highest capital growth market in Europe, in the biggest economy and the safest market, it's a little bit of a no-brainer in terms of your full return on equity. So this is how we see 175, 180, even 200% return on equity on these properties. So if you're buying safely in areas are going to rent, very difficult to see how you can't make a lot of money in this market.
I think there's a couple of questions that I'd like to go through. The first question is, do you use capital appreciation of the asset in your IRR, your returns calculation? If so, what escalation?
Well, I mean, yeah, we do it. All our cash flows. We have very detailed Excel breakdowns of every investment we look into. And yeah, I mean, like, of course, those numbers are based on a prediction of future growth and rental growth. So what we do is we take major industry, CBRE specifically for Germany, they do some of the biggest reports. So sometimes you use those, sometimes others, but the major consultancy firms, we look at the kind of 5 to 10 year projections for growth, specifically for certain areas where our properties are, and we'll put those into our models. So what we'll do is let's say CBRE predicts that Mitte is going, which is the heart of the embassy district, is going to be growing by circa 8%, or 7% over the next while. We'll initially discount that at 30%. And then each year we'll discount by a further 10%. So to be pragmatic and risk averse, and to say, what this could look like, we'll discount what the major industry projections are, and then we'll model that into 10 years, because 10 years is a sensible amount of time for someone to build and hold. Beyond that, you're starting to do a little bit of guesswork in terms of economy, but particularly, of course, with Germany, that makes sense as well, because that's in line with the capital gains incentive for it. So yeah, we'll model in those kind of growth figures in line then with the cost of the interest and so forth, and come out to the euro what we hope and expect your return on equities to look like.
I think also just to add to that, this was Imran's question. Imran, every property that we advise you on, it comes with a full cash flow, with all cash statement, how it's all worked out in terms of the rental escalation and the capital growth of that asset, working out, how much deposit you're putting in and what borrowing rate. So it's, all of that is very, very transparent. And I think the next question that I'd like to get onto, which I'm not sure if I have the answer for this one. I'm not sure, Jeremy, if you do as well, but Samir is asking about Islamic finance in Germany and how rates would compare to traditional mortgages.
Glad you asked that. Short answer is they don't really differentiate in Germany. So sometimes the high street banks and sometimes those who'll be lending will be pension funds, actually. So the setup is slightly different there, but they don't kind of necessarily have Islamic products for mortgages there. But they are certainly probably the most flexible globally, I think I've come across here, in terms of how how you can repay the mortgage when the construction's happening in construction milestones, but afterwards how you can change every year how much you want to be repaying off. So if you had a slightly more aggressive plan of wanting to pay it off quicker, you can set up originally with a 30-year term, but if you choose your maximum amount of repayment, you can repay the entire mortgage off within 7 years if you wanted to. So yeah, short answer is not specific Islamic finance products, but there are a handful of different options that we can talk about in detail with you. I see one there as well about the
nice, good question here.
Sorry.
Well, Sijal, talking about mortgage terms here and what the repayment terms and over what period. So in both Portugal and Germany, you can get mortgages which are repayment and interest. You can't do interest only mortgages in those countries. So you have to do a repayment. So the tenant will be paying off the mortgage. And the terms you can do it are, you can do 10 years, 25 years, you can do 30 or 35 years. So you can spread those payments over a long period of time. So, the maximum is 35. I think it's really up to you to decide what's comfortable for you in terms of the length.
Yes, I ask that semi-regularly about kind of like, if someone has a plan maybe to repay a property off in 10 years. And actually, what I tend to try and remind people of is, like, if a bank's offering you a 30-year term, you're not locked in for a 30-year term. It's just allowing you to have, smaller repayments on an annual basis. So I tend to advise people to take the longer term and, just make sure you're not fixed into a product where you couldn't overpay, because most of them will have, options for overpaying maybe after an end of a 2-year fixed period. So don't give the bank the power to decide when you're going to repay and set up a 10-year mortgage. Set up a 30-year one, and when you have the funds available, then drop them in line with the original agreement you set up. So keep the flexibility on your side, is what I generally advise there.
That's a very good point. Very good point, Jeremy. You know, these mortgage terms. So in Germany, for example, you can fix the 1.5% interest rate for 10 years. So you know, if you're buying that property and we've got the cash flow worked out, you know that your interest rates aren't going to change at all in that time. They're completely fixed. So it's interesting. It depends on the product. But
I quite like the question that came in at the bottom there. It's about why not consider in the UK. We massively do. Don't you know? Like this is certainly not a session where we're saying you shouldn't. It's still it's probably the prime market in the world for a lot of people to be buying into property. But I think what we're showing here is some of the advantages of some of the other markets, which maybe not as obvious. But no, the UK is a safe haven status, and it absolutely is. You know, growth to be had there. Taxes have been hit hard over the last kind of 10 years. It's gone up, but that's reflective of how safe and, you know, how attractive it is on a global scale. You know, like you are, you know, you have to put your funds in there to be able to hold on to that asset. And as I say, you can deduct them when you come to sell the property off your capital gains in the end. But, you know, it's the stamp duty holiday is certainly an attraction at the moment for people to get in the UK up until up till September time. But it still will be after that. You know, that's just a little pusher for market basically for current period. But no, UK is not going away. We're just equally keen on these markets, is what we're trying to say.
Absolutely. And I think just to add to that, we're very much heavily invested in the UK still, and so yeah, we see a long-term growth for the UK, as we do Germany and Portugal, but they all have different. There are differences in each market, which we clearly have worked out, But I think the one thing that Germany and Portugal do have an advantage over is that international financing is so much more affordable. So for my clients in Kenya, generally we're getting just over 4% in interest rates per annum. Whereas, as you can see in Portugal, we can get mortgages at 0.68 and in Germany at 1.5%. So, you know, and the leveraging is such a critical part in terms of maximizing your return on equity. Or it's just a big part. So it's, you know, there's differences in the markets, and I think it's good to have a diversified portfolio, be investing in not just one market, but look at you know, the broader spectrum.
I think we're almost coming up to the hour now, so quite a long one. I think there's just a lot to talk about. That's all reflective here. So by all means, like if we haven't covered all the questions, I see there's a few more there, and apologies, but absolutely we can follow up on those afterwards, and we can have a discussion. But for anything here that you're interested in, do reach out to, you know, respective, you know, the department around the world. We've got offices everywhere, so please do, you know, reach out to your guys. And we're happy to have a conversation there. But, you know, we are continuing to try and bring education and our research to our clients and share that as transparently as possible. So, you know, you tell us as well what you're interested in, and, you know, happy to keep helping to build portfolios globally. But anyway, we're,
great.
On behalf of myself and the company and Andrew, thank you very much for your time, and we'll hope to speak shortly.
Yeah, thank you very much indeed.
Thanks a lot. Bye-bye.
Thanks, bye.